Can SBA fund your startup, get you off the ground? How easy is it to do this? How does this even work? Today we're going to dive into the mysterious world of the SBA, known as the Small Business Administration. So let's get started. So first off, SBA stands for the Small Business Administration. It is a government-backed entity, and the first bit of disinformation, misinformation we may have with SBA is, hey, I'm going to get an SBA loan, so SBA is lending me the money, right? Wrong. SBA is not lending you the money. The way SBA works is actually they back up the banks and local credit unions that actually give out the SBA loans. And so whenever you take out an SBA loan, it's actually coming from your local bank, your local credit union, could be a national bank as well. And what's happening is SBA is the foundation. They're backing up that loan. So what that means is if, your local bank gives you an SBA loan for $100,000 and something goes wrong and you're not able to pay the loan back, well, that bank is going to get 80% or, give or take 80% of the loan is going to be covered if you don't pay it back by the government. So if you're a bank, you're like, well, geez, why would we ever lend our own money, which has 100% risk, when we can lend SBA-backed money and it only has 10, 20, 30% risk, and so it's a lot lower risk for them. So that said, what are all these SBA programs? Well, there's a few different programs. You've got the SBA 7A program, you've got the SBA 504, you got the SBA Express, you've got the SBA Microloan, and then you've also got what's known as the SBA Bolt program, which is a new program out there. And then you also have the EDL program, which we'll talk a little bit about. So let's talk about it. So the 7A is what we're going to talk about most because that's really the only option to fund a startup. There's also these microloans, which are also for startups and small business owners, but they're very small. The average microloan is usually only about $13,000, so pretty small. And you have to jump through a lot of hoops to get that money, but if it's your only option, you may do it. And so that's microloans. The 7A is a growth loan, a working capital loan. It is something that they do like to back with collateral as much as possible. But if you're looking for a decent size of startup funding, that 7A is really your best option. The 504 is more about collateral. It's about equipment and commercial real estate, and you're buying a tangible physical asset that is going to be collateral in case you don't pay it back. So it covers the bank's SBA loan risk with that, and that's a 504. The Express is only for established businesses with at least 2 years of profitable business tax returns, usually capped out about $150,000 and can be gotten out usually much quicker than a lot of SBA loans. And so those are the different options out there. There's also a new one called the SBA Bolt, very similar to the Express, usually capped out at $150,000, sometimes up to $300,000 if you have some form of collateral. And again, looking for those established business owners. The Bolt is kind of a newer version of that Express and is funding much quicker. So in terms of startup funding, it's really just the 7A. And so how do you actually qualify? Well, let's start with credit first. Credit score needs to be a 640 or better FICO score. That's the SBA guidelines. But remember, that's SBA's guidelines. But not only does the SBA have to give their stamp of approval, the bank that's actually lending you the money has to as well. And so that bank may have, on average, much higher credit requirements. It might be 660, 680. I would say the average is definitely over 700 on that FICO score. So FICO score is going to play an important role. The next factor that they're going to look at is collateral. They still want collateral. Boy, if you have an old 401k, perfect. We'll take that as collateral. So collateral is an important factor. Also industry. If you have industry experience, that's going to be an important factor. They want to lend to people who have experience in the industry. They don't want people, hey, you've been working in construction all your life and you're going to go ahead and start a restaurant franchise. I mean, the fact that it's a franchise helps, but if you're just trying to start an XYZ restaurant business and you have zero experience in it, then they're going to be much less likely to give you the money for SBA. SBA also, with its startup program, the 7A, has a down payment requirement. Wait, down payment? I thought I was getting a loan. Yeah. Well, when you buy a house, you need a down payment. If you want an SBA 7A startup loan, you're going to need a down payment. Starts at usually 10%, can go all the way up to 25%. So if you need $250,000, you're going to need minimum $25,000 down payment, maybe more, in order to qualify for that startup SBA 7A loan program. Industry also plays a factor. If you have an adult-themed business, if you're a real estate house flipper, if you're in insurance, if you're in what they categorize as higher risk industries, then it's going to be impossible to get an SBA loan because they only lend out to the lower risk industries, which most industries they do classify as lower risk, but some of the higher risk ones are going to be outside of those guidelines. Now, the next question that you might have is, okay, so those are the different qualifications. What about income? Well, it's important if you have a W-2 job or another business that is making you money that you keep that and maybe start this on the side to get your SBA 7A startup loan, because they like to see additional income coming in that can help pay the bills in case the business struggles or takes more time than you anticipate to get off the ground. In terms of time frame, the 7A loan can take several months to get through. Again, some of these other options, if you're an established business owner, can be much, much quicker. Now, what we also want to address here and let you know is that there are alternative SBA options. And so these alternative SBA options out there to get your startup off the ground, sometimes you have an old 401k or IRA. Well, you can turn that into a self-directed IRA or even get a loan based off of that. Usually the minimum is you need to have at least a $25,000 old IRA. But you can get a loan off of that to fund your startup. That's an alternative SBA startup option. Another alternative are personal term loan programs based off of your verifiable income, usually from a W-2 job and at least a 650 FICO score. That's another potential option to look at. And then the third SBA alternative option is the 0% interest business credit card stacking program, which is another very popular route amongst entrepreneurs. So all that said, we've talked about SBA, we've talked about the options, the reality, we've talked about SBA, startup funding alternatives. I want to leave you with 2 additional videos to help you on your journey as an entrepreneur and understanding money, funding, and finance. They didn't teach us these things in high school and college, so that's what we're here for, to give you that competitive advantage that your competitors probably aren't going to have when it comes to money, finance, and credit. So the first video I want to share with you is unlocking the 0% interest credit card stacking program. What are the ins and outs? How do you qualify? How does this program work? Watch that video here. And then the second option is going to be the top 5 startup funding options. We really dive a little bit deeper into this in 2024. So check out those 2 videos and we'll see you next time.